So you have to ask yourself today, what's a good place to put your money? Knowing that Fed's lowering rates, why are they lowering rates? And how can you position yourself to still capture the good, but be prepared for the bad? Welcome to How to Retire on Time, a show that answers your retirement questions. We're here to move past that oversimplified advice that you've heard hundreds of times. Instead, we want to dive into the nitty-gritty because the truth is, there's no such thing as a perfect investment product or strategy. Nothing does everything well, so let's dive into the details and figure out what's right for you. Now, text your questions to 913-363-1234, and we'll feature them on the show. Remember, the show is not financial advice. Do your research. All right, David, let's dive in. What do we got today?
Hey, Mike, what should we expect from the market now that the Fed is cutting rates?
This is a tricky one because we're talking about economic theory, speculation. So it's kind of like saying, well, what's the market going to do next year? I don't know. No one really knows. But there are some breadcrumbs that we can at least follow.
Okay. What are those breadcrumbs?
So in any time there's an indicator, a thought, a headline, you've got to ask yourself, what don't I know that would influence my outcome, that would influence my opinion? And that's just a general good thought process to have. What don't I know? What am I not seeing that might influence this? So why would the Fed lower rates?
Good question.
The simplest answer is really two trains of thought. One is inflation's in control and it doesn't need to stay high so that they can lower it off. You know, they can kind of take it back a little bit. Or maybe there's something wrong with the economy. And if that's the case, then it's like, hey, something happened and it's either really, really good or really, really bad. Which is it and how is the market going to react to it? And which way are we going? Now, they only cut 25 basis points.
And so what does that mean? Translate that for me.
0.25%.
Okay.
And this is important. Well, yeah, what does that mean?
Yeah.
The Federal Reserve has a rate that is basically the cost of money if you're a bank or an institution and what you could borrow it from. And there's only so many institutions that can borrow from the Fed. Overnight rates, covering their liquidity, and so on. That has a ripple effect that goes to all other parts of the financial institution. It does not control your mortgage rates. It does not control your auto loans. That is more based on the 10-year Treasury, which has a lot to do with debt, financial stability, the credit rating of the United States, and so on. So when people say, oh, well, you know, they're lowering rates, things are good. Well, they rhyme. The Fed's rate rhymes with typically 10-year Treasuries and auto loans and mortgage loans, but it's not correlated. It's not tied to the hip.
Okay.
Does that make sense, or do I need to kind of?
Well, let's unpack that a little bit more. So yeah, so it's rhyming. So does that mean they're near each other, they're close to each other? Or?
Well, it's like, let's see. You have to understand there are two markets here. The Fed's market is controlling the monetary supply. No, it's controlling the rate the banks can lend.
Okay. All right.
The Treasury Department, you know, if you buy a Treasury, U.S. Treasuries, which is like the safer side of the bond market, which the bond market is the debt market.
That's like government debt, right? Treasury?
Government debt, and you can go to corporate debt. So when you buy a bond, you're basically buying someone's debt. You're buying a company's version of their credit card and agreeing that they're going to pay you interest, 4, 5, 6, 7, 8, whatever the percentage is, assuming they don't default, that they're going to pay it back. So they're going to give you back the principal, the original amount, plus interest. That's what the bond market is. The bond market is the largest market. It's way bigger than the stock market because the American economy was built on debt, borrowing from certain people to advance business moving forward.
And that goes way back to like the beginning, right? Like way back.
But America was built on debt. That's just how it was. So going back to, you've got the Fed, which is basically controlling the cost of money to banks, which then it trickles down to certain aspects of the money supply or the cost of money and their liquidity and all of that. And we could really we could spend hours on that. But the Fed is more controlled on banks and rates and so on. When you buy a mortgage, as in you take out a mortgage, the average person's probably, and this is an actual quote, but this is more of like just, they're going to probably stay in the house for 10 years. Why 10 years? Well, because mortgages are 30 years, right? Yeah, but they're going to like stay in that house for 7 to 10 years, and then they buy the next house, and then they buy. So they're typically going to go off of a 10-year treasury bill to price all this in. Well, where do you get the treasury bill? From the Treasury Department, not the Federal Reserve.
Okay.
So Scott Bessent, he's the Treasury Department. Jerome Powell, he's the Federal Reserve. They don't necessarily get along as well as maybe you'd like, but they're also completely different. They're independent of each other.
2 different buildings in Washington.
I guess, yeah. I don't know the location.
Yeah.
So Scott Bessent and the Treasury Department, when they need to issue new treasuries, what do? They go out to the market and they say, hey, market, I need to, let's just say, I need to have $10 billion of treasuries. I need $10 billion to cover certain costs.
Okay.
So he's going to go out and say, all right, here's $10 billion. If you take one of these notes and they're in $1,000 increments, we're going to give you 2%. And people would say, well, that's a bad deal. I don't want that. It's not worth the risk that I'd be taking. The United States government has a lot of debt. There's some financial uncertainty. You've got the tariffs. You've got inflation. The job markets have kind of been a little bit off, especially with these massive changes on, hey, we said that the jobs were this amount, the unemployment was this amount, that this was what was growing, but it's actually very different. So there's kind of some uncertainty here. So 2%, that's not worth it. Scott then puts out feelers and says, I shouldn't say Scott, let's be respectful. Secretary Bessent, I mean, it is a respectable position.
Sure, yeah.
We'll be respectful of our political leaders, regardless of political affiliation.
Right.
So Secretary Bessent comes out and says, well, how about 3%? Crickets. How about 4%? There's some wrestling. How about 4.5%? Okay, I think that's a fair trade for the risk that's being taken.
So investors would see that 4.5%, whatever, and say yes.
Yeah. The market dictates what they're willing to pay for new issues of these treasury bills. So when I say it rhymes, how the monetary supply works, how the Fed influences the bank and the cost of money, how they influence inflation, if they make money cheap for banks to loan to businesses and all of that, that's going to affect a lot of factors. But the market also has its opinion, will affect the Treasury Department. So all of this is like a nice salad of financial theories of what's going to happen in the future. And it all comes back to this simple question: is the economy healthy and positioned for growth? Is the economy positioned for growth with inflationary issues? So if you have too much growth, you could have inflationary problems. Okay? Or is the Fed lowering rates because the jobs don't look as good, the economy is actually weaker than has been reported, and they're concerned about a recession, and so they're trying to make money cheaper to make it easier for business, easier for banks and lending and so on, so that they can try to get in front of a recession before it actually happens. And no one actually knows which way it's going to go, because this is all a bunch of theory, a bunch of data points that would suggest something, potentially leading indicators. But those indicators, it's not solid opinions, it's hints. It's kind of like, you ever put one of those like 1,000 puzzle pieces together? It takes forever.
It does take forever.
Okay, when you get data points about the job market, about inflation, CPI, and you look at, okay, well, here's the total CPI, but here's the CPIW, or here's your CPI core. It's like you got 5 pieces of your 1,000 puzzle piece. Okay, well, we see kind of that's what could be happening.
Okay.
But they don't actually know. No one actually knows. These are data points that suggest what could be happening, and then they try to make educated decisions. That's why the Fed comes together. So, you hear about the board.
Yeah. There's all
like
these...
the new person was added to the board, the person was taken off the board, and all of that. The board, it's full of conflict and heated debate on what's actually going on from some very smart people on both sides of the aisle that are trying to figure out what to do.
Yes, okay.
So what's the economy going to do? I really don't know. this goes back to my theory of bad news bears. So we could have a bear market, as in the markets could go down, they could collapse, they could go to a recession. It could be a light recession, it could be a deep recession, it could be a depression, or it could be a sign that the markets continue to rise and that we are growing and we're able to grow at a rapid rate and inflation's not going to be an issue. Now, there's another theory behind this as well. You know how Trump's
lots
kind
of theories out here.
yeah, Trump, and I'm trying to articulate all the different trains of thought
Okay.
because at the end of the day, it's no one knows, but here are theories and their argument for the theory. Because if it was easy, everyone would know, and it wouldn't be an ongoing debate. It would be, all right, this is how it's going to happen, and we'd position accordingly. But it's economic theory. So another theory, this is more of a fringe theory, but Trump is pretty smart when it comes to debt and how to manipulate it, how to abuse it, how to get out of it. I mean, if you look at his career, whether you love Trump or hate Trump, he has used tax code and debt to do all sorts of crazy things. I mean, just
yeah, all the businesses, casinos, et cetera, et cetera.
People complain about, well, he files for bankruptcy all the time for different isolated. Yeah, he used the tax code as written to do crazy things. Would I invest like he invests? No. Would I be operating how he's operating his business? Not a chance. But did he do it successfully? You could argue to some extent, yes. Now, how much success? Should he have done better? Should he? That's just everyone's opinion, whatever. I mean, whatever your opinion is, it's probably a biased opinion based on if you want to love him or hate him.
Sure.
That's the reality. But he did it. He understands debt probably better than most other people in business. So when you understand the country has a lot of debt, when you understand that the Federal Reserve's job is to help hedge against inflation while also trying to not let the economy go into a recession, when you understand Trump's trying to label Powell and saying, too late, Powell, or whatever these names are.
Oh, yeah.
What's the new one? Better late than never, Powell? I don't know. Whatever he says.
They come out often.
What if, and this is speculation, what if a reason why Trump wants to have Powell lower rates drastically is to, one, grow the economy so that he can pay for the one big beautiful bill, supply chain economics, you grow the economy, it pays for its taxes, it solves a lot of issues as well, but also inflates away debt. If we do have higher than normal inflation, but the economy grows fast enough that you can increase the Social Security wages, you can increase all these other things. So it doesn't really hurt people. It's just we're devaluing money or inflating away our debt. That is one way that you could address our debt issue. It's, again, economic theory. It is more on the fringe, but there is a train of thought for that. Now, whether it's right or wrong, whether I believe that's the right way or not, I'm not saying that at all. I'm not in any political power at all. I enjoy not being political, but I enjoy talking about the different trains of thought because when you hear these crazy accusations, they're not crazy. There's actually an argument for them. The question is, will you stop and think about it and say, well, what don't I know that would affect my opinion or change my opinion to understand why someone would suggest something that seems crazy but actually has reason to support it? It's like people say, well, Trump's tariffs cause inflation. That is an opinion based on certain historical data. There are other historical data points that would suggest it doesn't. And people cherry pick the data just to love or hate them.
Sure.
But the reality is, yes, the Fed is cutting rates. That means something.
Yeah, and so what will it mean for the everyday investor that's out in their car right now or on the treadmill? And what's it mean for them, if anything?
Yeah, getting their laps in while they listen to the show or watch the show.
Yeah, you can watch it
on YouTube.
See our beautiful faces.
Shameless plug.
Yeah.
So here's what I believe the everyday investor should consider. This is not investment advice. We're just talking about general good financial principles. If the Fed lowers rates and inflation does get out of control, cash is trash. If the Fed lower rates and the markets crash, cash is king. What's the lesson here? Don't put all your money in cash Maybe you have some money in cash or cash equivalents. Maybe you have some money in growth assets that have protection. So you're thinking of structured notes, buffered ETFs, fixed index annuities if you're older and you need the annuitization component, or to some extent there. Maybe you do have some assets in ETFs that are kind of broad. What's interesting right now in our portfolio, at least, we have a lot of the assets in ETFs because we really don't know which sector is going to take off effectively. We know, at least as of late, that defense has done well, robotics has done well, AI has done well, fine. But will that keep doing well in the future? We just don't know. No one knows the future, so we have to track these sorts of indicators, these trends. The S&P continues to do well, but how long is it going to do well? Is it melting up, or is it going to kind of correct? We don't know. But having that broad exposure has been very interesting because most of the S&P's returns this year so far have been with a handful of companies. That's a heightened level of risk. So in our portfolio, we have started to allocate, at least for Kedrick Wealth, part of our positions to more boring companies.
Yeah, and you're using boring as like almost it's not a
Think of like
insult.
Costco, for example.
Yeah.
That's something that we are interested in as a company. Costco has a good business model. It might be more boring. It might not grow as well as like NVIDIA this last year. But you know what? When markets tank, what's going to probably do better? If AI tanks, Costco's probably not going to go down as much.
Right, okay.
So we're trying to hedge not our bets, but we're trying to buy certain positions that are long-term that can keep up with the S&P, but don't have as much risk as maybe other positions might. It's just a more well-rounded portfolio, in our opinion. So you have to ask yourself today, what's a good place to put your money? Knowing that Fed's lowering rates, why are they lowering rates? And how can you position yourself to still capture the good, but be prepared for the bad? We call it a bear market protocol. If the market's crashed, how do you sustain your quality of life during the market crash and the time it takes to recover? That doesn't mean all your portfolio is in something for that quote-unquote protocol. It's that you want to grow your assets, but have a protocol in place in case something were to happen. Yeah, any other questions? Any other thoughts?
Yeah, so is that a significant amount of 25 basis points, right? Should it have been 50 or a full percent? I mean, why doesn't Jerome Powell go all in and just, hey, let's do 1%?
Too much, too fast could send shockwaves. It could create panic in the market, like he knows something that others don't. It could be you want to. It's kind of like when you gain a little bit too extra weight. Let's say Thanksgiving and Christmas, you gain a few extra pounds.
That's happened to me. Yes.
Yeah, January hits and you want to just shed the weight. You don't go January 1 to some plastic surgeon, whoever does these things, suck out all the fat and call it good. You just you get back into your workout routine. You get more in tune with your diet, and you just slowly shed the pounds.
Okay.
So there is something to be said about slowly adjusting the rates towards the direction you want to go, and then watching how the markets react as well. It's a very thin line that any Fed chair has to walk. And so my personal opinion is that the markets are overvalued and that it is better to maintain a higher interest rate and, yes, hurt some companies, hurt the growth of the economy a little bit, so that whenever the markets crash, there's more room for him to drop rates and make money cheap and speed up the recovery. Because if he lowers rates too much, you're not going to go past zero. So if you give up too much room too soon, that might actually make it's like, let's say you've got food storage. Okay, you've got 6 months of food storage, and you're like, I'm not going to lose my job. So you start eating your food storage. Now you've got, let's say, 2 months of food storage left, and then you lose your job, and the market's crashed, and you're now hurting for cash. You don't have the same wiggle room that you had with 6 months of food storage. You only have 2 months left. So I personally don't see a reason right now to lower interest rates aggressively. 25 basis points, to me, it's not a big concern. But if he did 50 basis points, 75 basis points, or even a full percent, I'd say, either something's horribly wrong or we're being too aggressive and hyperinflation can get out of control. We could have another normal inflationary rate, not hyperinflationary rate. We could it could be a drastic sign for a recession soon to be coming out. There's just more sirens or red flags would be going off in my mind.
Okay.
So that's kind of my take on it. It is an opinion. No one really knows. So don't bank on speculation. Have a plan. Have a portfolio. A comprehensive overview of the good, the bad, and the ugly so that you're not banking your entire livelihood, your entire quality of life on trying to get these things right. Be set up so that you can be right and you can be wrong. And it's okay either way. Hey, thanks for watching this video. Make sure that you like and subscribe first, and then go to www.retireontime.com to grab a copy of my book, How to Retire on Time, take a few courses about retirement, join my newsletter, and so much more. Now, if you want to work with one of our advisors here at Kedrick Wealth who can help you put together a retirement plan that's designed to last longer than you, just click the button, Get Started. Everything we do is intended to help you retire on time. We hope you enjoy, and we'll see you in the next show.